everyone. My name is Nicole. I'm UpStack social media specialist, and I'm very excited to have Ben here today. He's UpStack CFO, and he is going to go through a presentation all about how founders, managers, and anyone working in startups essentially can best handle an economic downturn like our current economic status today. We thought this was a very relevant topic since a lot of startups who might have started in the last few years might not have experienced a lot of economic challenges before, and it can be very jarring to go through this for the first time, particularly if you don't have a financial background. So we thought we'd have Ben, who's our financial expert at UpStack, to go through how these founders and managers can best prepare themselves, prepare the finances of their team, and everything so that they can be more successful moving forward. Thank you so much, Ben, for joining us today.
Thank you, Nicole, and hello to everyone out there. Lovely to be here. And as Nicole said, we're talking today about strategies for dealing with economic downturns, and we are going to talk about it from the viewpoint of someone in a startup. You might have just recently joined a startup, or you might be the founder themselves. It is basic. It's not meant to be taken as financial advice, but it is meant to start the conversation and get you thinking about things that you can do when we are faced with the problem of an economic downturn. Nicole's going to kindly run through the slides today. So Nicole, if you can start sharing the screen and just go to that first slide.
Yep.
Thank you. So yep, that's just a cover. Then the next slide will just be me, a quarter of my face. I'm the CFO of UpStack. If you don't know, I've been here for about a year. And Nicole, if you can just go to the next slide, please. So why are we here today? And it's really about just trying to build a picture of what's important for you as a member of the team in a startup or as the founder themselves. And when we look at what happens to a startup during an economic recession or a downturn, you know, it creates a lot of stress on the business. And if I could build a picture for you, you know, you're the founder or you're someone in a company, in that company, and you're starting to see a reduction in revenue. You're starting to see pressure on your margins. You are seeing liquidity dry up. So the venture capitalists, the investors, the banks, the finance people who are all rushing to speak to you last year, they're not around anymore. They're not picking up the phones and answering your calls, and they're taking a long time to reply to your emails. So that, coupled with the fact that interest rates are more expensive, are higher, sorry, and capital is more expensive, that you know, creates a situation where you're less able to borrow, or you're less inclined to borrow, I should say, and your runway, the amount of money you have left before you run out of, the amount of time you have left before you run out of money to service your business, that shortens. Along with increasing prices, inflation, that impacting your bottom line through increased operational expenses, all of these factors, along with, you know, the idea that some entrepreneurs in the startup world haven't ever faced this kind of situation before, and they're not experienced with it. So all these factors, not necessarily in isolation, but together, create this immense level of stress for a startup. And it's different from other types of business. If you think about a startup and how they're completely focused on growth, they don't necessarily have a revenue stream, and they've got to start thinking about how they're going to survive without money, without revenue, and without investment or funding. And because of that, they might have to think about how to pivot, you know, their operational and business strategy. This is in direct contrast to other companies, you know, value-driven companies who are already committed or stated their intention to be profitable. And those companies have existing revenue streams already. You know, they've already had the opportunity to look at their operational expenditures and try and tighten it up. And because of this, they are already in a better position. So you as a startup entrepreneur or someone in a startup really need to start to think about what you need to do to shift away. So Nicole, if you can kindly go to the next slide. Thank you. So this, what I wanted to talk to you today on this slide about is really about how do we know? How do we know we're in an economic downturn, and what are the pointers or the indications or the signal that startups have to show that that they need to be aware of this happening to them? And I like to use the analogy of a human, and that's the reason for that slide. Like a human, economy has inputs and outputs, and depending on the variation of them, you're going to have a healthy baby or kid, or an unhealthy baby or economy. And based on the consensus view, the macro big picture of what's happening with interest rates, what's happening with growth, the impact of inflation, and so forth, will determine, a world view of, or a personal view of what's happening to you. And some of the things you can look at, some of the indicators that are helpful for someone in a startup, are things like valuation. So do look, I mean, again, those VCs, those private equity firms, those finance companies and banks that were coming to you last year, they're coming to you this year with a very different proposition, a very different valuation. Take note of how that's changed over the year. That is a critical indication that something's changing, and that forward consensus, or the forward view of expectations of future earnings, has changed. Stock market's a really good way also to indicate that particular sentiment, and you can see that the recent decline in stock market, in values in the stock market, is reflective of that overall sentiment that future income related from these industries is likely to decline, or it will likely to be less than it was previously. Also look at your sales funnel. So as you're getting new clients, look at how they're changing. And this is particularly interesting for us here at UpStack, because we noticed over May, June, as the cryptocurrency market was collapsing, that a lot less of these types of companies were contacting us for our services. So the composition of your client base starts to change, and that's another interesting indicator that might point you to seeing how you might need to pivot or shift that business model. We use a lot of internal metrics to track client spending. We might have up to 70 clients at any one point in time, and because of that, we need to know who's spending less, who's spending more. So if someone is spending less, it might be an indication that there's a problem or there's a view within their own company of the impending, impact of the economy on their own business, and they wanted to spend less. Other things that you might want to look at, and these are the classic ones, are about accounts receivable. The amount of funds you need to write off to bad debts, delinquencies. And then just clients coming to you and asking for extended payment terms. These kind of things can really point to problems within the company with their own cash flows. And finally, just looking at your runway and looking at how that changes. So again, this is just the amount of time you have left to service the operational requirements of your business with the money you have in the bank. As that changes, you can look at the different reasons for that changing. And that gives you a good indication of why you might be heading for trouble. But it's not these factors in isolation that signal that there might be an issue around your company or your business model. It's them all together that really gives you some impetus to start asking the questions about what's happening and what you might need to do. And Nicole, if you can go to the next slide, it's a note on capital. Capital, there's two types. There's CapEx and OpEx, and working capital, I should say. And then from the point of CapEx, CapEx is just all those projects, those businesses that you have, working on, and you have funding for, that are designed to generate revenue into the future. And for a startup, CapEx CapEx is really critical to the growth part of your business. And you know, when a startup is hit with an economic downturn and liquidity starts to dry up and there's more operational expenditure, you've got less money for those projects. And because of that, the consensus, and a lot of people will say, that you need to focus on your minimum viable product, your MVP. So it's about a shift away from all the activities to one activity. And there's a really good example of this I want to talk about today called Katerra. Katerra is a really awesome company, I thought at least. It was a construction company that had lots of verticals. Its main thing was it had a composite construction material that was sustainable. It had robotics that could help build this, and it had a number of really interesting projects across the USA. But the problem with Katerra was that they didn't really have an MVP, a minimum viable product, to generate them revenue. And because of that, it collapsed. And there was a whole host of investors who lost a lot of money in Katerra. And the point there is just that shift, the shift from that growth model to something that's just generating new income. The other point about capital that I wanted to make was about working capital. And working capital is just the money that you need to sustain the operational day-to-day requirements of your business. And as you go into an economic downturn, if you're a startup and there's a lot of stress on the business and managing the cash flow between receipts in from clients and payments out to your vendors, you might need to extend that working capital or increase it by getting a better facility with another bank or extending your line of credit. It will be more expensive because the interest rates have increased, but it will give you that peace of mind that you're able to service the business, extend your runway, and fight your way through the impending doom of an economic collapse. So Nicole, if you just go to the last slide, this slide is really just about what you can do. And I've really got 4 points there. I've broken them up into funding, revenue, expenses, and contingencies. So from a funding point of view, what can you do if you're a startup? Again, the picture is your liquidity is drying up. Your operational expenditures increasing. You've got a lot more money being paying out to pay out your loans. What else is happening? You're not really sure what to do. You never had this problem before. So the first thing about funding is, lock in whatever term sheets you do have. A term sheet is just an offer of funding. You might have investors out there. You might have a facility, some kind of offer from a bank or a finance company to lend you money. Whatever it is, the terms are most likely to be a lot favorable now than they will be in the future. So lock it in if you can. Next point about revenue is, again, to lock it in as best you can. If you're a subscription-based model, one of the things you might want to think about is really getting a tight process around the expiry of the subscription and the prepayment of that subscription into the future, and sweetening the deal by putting a discount on a subscription for the whole year as opposed to month to month. And that way you can get that extra income in for the whole year, extend your runway. So these are the kind of things that you like to think about with revenue. Of course, with revenue, if you just grow and you hold your expenses the same, your proportion of expenses related to revenue actually decreases. So if you're just growing, it's fine. But what we're here today to talk about is the situation where you're not growing. So try and do all these different things to maintain your runway. The point I wanted to make about expenses today, of course, expenses is going to be something that's really going to be a focus point on any discussion around how to maintain your runway out into the future. I didn't mention in the working capital part of that capital slide, but it's it's a well-worn cliche that companies live and die by their working capital, their ability to control their expenses and generate as much revenue and cash flow as they can. And from that point, from the expenses side, I think one thing you can do is look at, if you haven't already, is look at expense management systems. An expense management system is just a system that helps you manage expenses. I know that's not a very helpful definition, but bear with me. The key component for me is really around virtual cards. So a virtual card is just like any normal credit card or debit card, but it can be used for a one-off issue. You might have all your expenses on one card. With a virtual card, what you can do is allocate each expense to each card. So let's just take LinkedIn, for example. You might have LinkedIn Recruiter, you might have LinkedIn Sales, you might have LinkedIn Premium. You might have that all on the one card, but you want to cancel LinkedIn Premium, and you've got to call them up and you've got to wait on the phone for 3 hours. Instead, what you could do is have a virtual card for each of those. And so if you wanted to cancel LinkedIn Premium, you could just cancel the card as opposed to ringing them up and canceling the subscription. You can get as many virtual cards as you want. It doesn't cost any extra money. So it's a really good way of having control over your expenses and having visibility over what's being spent where. So you can set limits on each of these cards. You can get approvals by different parts of your company. There's, as I said, much more visibility over who's spending and what and where. You can have reporting capabilities that are a lot more enhanced than anything you could find on an Amex website. It can link straight to your GL, so you get automation around the categorization of your expenditure. So your accountant will love it, and your compliance team will like it as well, because you can set any compliance rule or requirement around that. Just say, for example, needing to attach a receipt to every expense. So expense management systems, if you haven't checked it out, check them out. Just Google it. Airbase, Concur, there's a whole host of them. It's a really growing ecosystem with a lot of different features. Definitely check it out. The next point I really wanted to make is about prepayment. Payment plans. So, when you're in a company and you get a bill, it might be the case that you normally just pay it up front and you don't think about it. But if you can go on a payment plan and spread out the payments over an extended period, it's really going to lessen the burden on your P&L. Things like tax, things like office equipment, those are the things that you generally already have payment plans available out there to do it. So do think about that. And the final point I want to make about expenses is about reducing your office footprint. We've all been through the pandemic and realized, how flexible we can be with our working life. Maybe you're only seeing 70% of your workforce come to the office at any one point in time, and so you could probably get a smaller place and reduce your rent rate. So examine, your office footprint and your requirements, and consider moving to somewhere a bit smaller. The final point about contingencies, look, you can speak to insurance people. There are ways to get coverage over, these types of circumstances. But really what I wanted you to do, and this is something that I did myself personally at UpStack in the beginning of the year, when we got all those signals, we saw that, our valuation was decreasing. We saw that revenue was getting impacted. We saw prices were going up. We saw our sales funnel was changing, that the crypto people weren't talking to us. And we thought, what should we do? And I said, the only thing I can really do right now is control my expenses. Our sales guys need to find more money. Our success guys need to upsell our product. But what I can do in finance in a startup is control my expenses. So I went through every single expense. I went and understood the rationale for each expense. I questioned it with the people who needed it. I tried to understand what would happen if we didn't use it. And I built a picture up of what is absolutely critical to sustain our business model. going forward. And as a result of that, we're able to save a lot of money. And it's through that exercise that we were able to really, go into this economic storm with quite an optimistic view of our chances coming out really strong. And if there's just one thing I want you guys to do today as a founder or someone in the startup, is to commit some time to going through your expenses, in shifting from that growth led to something with a bit more value, committing to your bottom line, to your profit, and doing that through getting some control over your operational expenditure. That's really about it from me today.
Perfect. Amazing. Thank you so much, Ben.
No problem.
Um,
That was fun.
Yeah. So I did have a few questions for you, particularly near the end of that. And I know you talked a lot about different strategies that people can go through, especially when, we're encountering these times. But for leaders that might be in engineering specifically, who don't have any financial background or knowledge when it comes to like business financials, is there any resource that you would recommend to them to get like a crash course in educating themselves on, like you had mentioned, a lot of accounting terms, like things like that, and knowing how to best balance things on their team? Is there any resources you would recommend?
Yeah, absolutely. I think first off, is a trusted advisor always, by any any circumstances. If you need to pay for it and you've got money, definitely do it. And if you can't, try and find someone that you do trust, that has experience in a startup or in that kind of situation. Beyond that, Investopedia for basic terms. I like to, there's this great company that Jason Kalkanaka started called This Week in Startups. It's got a treasure trove of stuff for startup community. Have a look in there. Do cherry pick your way through the internet by surfing through different, links that JKL might provide. There is a whole host of stuff out there. And I think really it's just being able to say, I don't know and I need to learn. And don't be afraid that you don't know. A lot of these terms seem really intimidating, but over time, you can master this, and you can master that part of your business.
Awesome. Perfect. And then I know, like, speaking of advisors, if a company, let's say, has not received funding yet, or they're really bootstrapped, would they be able to get by on the occasional consultants with an advisor, or would you recommend that like investing in a financial team or a financial CFO, like right from the beginning, will pay off in the long run? Like, which one is the financially savvy decision?
Well, it's interesting you ask that, because UpStack, until I arrived, didn't have a finance department. So it testament to the success. They 13x'd without me. So it's a good indication that it's not absolutely necessary to have a finance department, but it is necessary to have a CEO or a founder that's comfortable with finance, if that's the case. If they're not, and I do implore you. And the pivot point, the point of inflation is really around when you move from founder-led sort of growth-led to value, and something where your bottom line matters. As I've talked, that shift, that point is a really powerful point where a lot of things change in your business, not only just what your strategy is, but who you use to help you implement that strategy. So think about where you are along the time continuum of your company life history, and when you'll need it. It's not necessary, but it is helpful.
Right. Perfect. And then for, let's say, leaders that are thinking of what is the best financial investment I can make, what would you recommend would have the most success in the long term for like the best financial investment?
Yeah, first one, as I said, is a trusted advisor. But the second, third, and fourth, and fifth one, all the same thing. Like, have a system in place where you can know who owes you what money, that you can chase it up, you can follow it up, that you're engaged with your clients and their finance teams and the way they pay, spend money, resources, whatever you, if you don't have that in place, you're not going to make it. So yeah, those are the two things I would say are most important.
Okay. Just off the top of your head, do you have any tools that you recommend or any platforms that you've enjoyed in the past?
Yeah, well, I mean, those expense management systems that I was talking about, I thought Airbase really helped us through a certain period of our time to get visibility. I think, you know, if you're in a startup and you've outsourced your accounting and financing to another to an accounting firm, the way you get them to report to you is a powerful tool in itself. It's almost a platform in itself, and where you can make decisions. So get as much information you can through those sort of arrangements.
Got it. Awesome. Definitely one of the best investments I've ever made as my accountant, so I definitely agree. And then I know you mentioned a lot of information about making sure that your company is profitable before you make any like financial decisions in terms of like a big expense. But I so often hear from like leaders like, oh, you have to spend money to make money. So what is like maybe a go-to tip that you use to differentiate, even if your margin is thin, like when would be a great time to invest into a big expense, even if you're not that profitable in the moment, or when you should definitely freeze all expenses like that?
Yeah, I think that the point there is really to work out what's going to bring you income. I think in a downturn, it's fine to make a big investment so long as it's in your MVP and that you can guarantee that through that investment, you're going to get extended runway. Now, there's obviously going to be a risk. It's never always going to work out, but there's a connection between the investment and the return. If you're just spraying out money at projects that just seem like fun and just it's a fun little venture, this is not the time to do that. Investment in your minimum viable product that's going to yield you returns well into the future, and give you runway to keep on going and keep on building. That's the kind of thing that you need to think about. So don't be afraid of investment itself in a downturn, but just make sure it's in the right place.
Got it. Sound advice. Thank you so much, Ben. I have ran out of questions for you, but this was very helpful, and I'm sure a lot of our followers will find this very helpful as well. So this will be posted on the UpStack YouTube channel. And again, thank you so much for presenting the information today. It was excellent.
Thank you. Thanks, everyone.
Bye.